is HUMAIRA BALQIS. I will explain about the consistency. So at first, consistency principle states that once you adopt an accounting principle or method, continue to follow it consistently. In future accounting period, only change an accounting principle or method if the new version in some way improve reported financial result. The second one is business entity. The business entity concept states that the transaction associated with a business must be separately recorded from those of its owner or other businesses. Doing so requires the use of separate accounting records for the organization that completely exclude the assets and liabilities of any other entity or the owner. Thank you so much. That's all from me.
Hi, my name is Fitrah Nabila binti OTHMAN, and I will explain about the concept of historical cost. Historical cost is the price paid for an asset when it was purchased. Historical cost is a fundamental basis in accounting, as it is often used in the reporting for fixed assets. It is also used to determine the basis of potential gains and losses on the disposal of fixed assets. How do I calculate historical cost? Historical cost is often calculated as the cash or cash equivalent cost at the time of purchase. This includes the purchase price and any additional expenses incurred to get the asset in place and prepared for use. How are historical costs used in accounting? GAAP, which is Generally Accepted Accounting Principles, requires that certain assets be accounted for using the historical cost method. Fixed assets are recorded at their cost at the time of purchase. Inventory is also usually recorded at historical cost, though inventory may be recorded at the lower of cost or market. That's all for me. Thank you.
Hello, my name is SYAZMEERA, and I will be talking about the concept of materiality. So, according to the concept of materiality, financial information is relevant to the financial statements if it alters the judgment or perspective of a reasonable person. In other words, the financial statement should contain all significant financial information that might influence the judgment of a user of the financial statements. The idea of materiality is a relative one in terms of size and significance. While some financial data may be irrelevant to one organization, it may be important to another. When you contrast a small business with a large business, this becomes rather clear. Because of its size and revenue, a large firm may have tiny immaterial expenses compared to a small company's substantial and material expenses. Does that financial information merit to use of financial statements? Is the main issue that the materiality concept attempts to address? If not, the corporation need not be concerned about including it because it is relevant in their financial statements. The majority of the time, the qualitative and quantitative properties of financial information are used to determine its materiality. Professionals' ability to distinguish between material and non-material is frequently left to their experience and sound judgment. So, for example, the ability to keep track of spending is lacking for a small business bookkeeper. The account of miscellaneous expenses is where most arbitrary costs are documented. The account for the other expenses had 1,424 ringgit and 25 cents in it overall at the end of the year. The business has an 36,940 ringgit net profit overall. The expenses in the miscellaneous account don't need to be reclassified because they are irrelevant to the company's overall financial picture. So for the concept of accrual is a type of journal entry that is used to account for revenues and expenses that have already been generated or incurred but for which the corresponding cash amounts have not yet been collected or disbursed. Regardless of when the associated cash flows occur, accruals are necessary to guarantee that all revenues and expenses are recorded during the appropriate reporting period. Without accruals, a business income, expense, profit, or loss for a given period may not accurately reflect its level of economic activity. Under the accrual basis of accounting, accruals are a critical step in the closing process that produce financial statements. Without accruals, financial statements would be much less reliable. A liability which shows as a line item on the balance sheet is used in the double entry bookkeeping method to offset an accrued expense. If accrued revenue is recorded, it is offset by an asset such as unbilled service fees, which likewise shows up as a line item on the balance sheet. For example, accruals of costs for supplies and services from suppliers. A supplier makes a delivery at the end of the month but forgets to send the associated invoice. Prior to receiving the invoice, the business accrues the projected expense in the current month. The company does not employ accruals if it uses the cash basis of accounting to record its transaction. Instead, it only keeps track of the transaction when it gives or gets currency. Due to the possibility that timing delays in the flow of cash can change reported outcomes, the cash basis produces financial statements that are noticeably different from those produced on the accrual basis. For instance, a business could avoid recording expenses by delaying supplier payments. As an alternative, a company could pay its invoices ahead of time to record expenses faster and lower its short-term income tax obligation.
Okay, hi madam, my name is NATASYA. Okay, I will talk about comparability and going concern in accounting. Okay, firstly, comparability is a quality of accounting information that address the usability of financial information. Information that is prepared using the same measurement technique and reported in a similar fashion of considered comparable information because this information is similar and can be judged side by other similar financial information. Comparability is extremely important to the end of financial statement. If financial statement can be compared with other statement, what good they? You will be able to compare a company performance from year to year, let alone to competitors' financial statement. Without being able to compare and benchmark financial statement, the accounting information would be pretty useless. Okay, for example, assume that company A use the FIFO inventory method and company B use the LIFO inventory. Okay, all else being equal, company B financial statement would most like show less income because of a higher cost of goods sold. Okay, company A would conversely have a lower income but higher inventory. These two company don't have comparable financial statement. They use different method of accounting. In order to compare this statement properly, we must convert one of their inventory method to match other. Okay, next, it's about going concern. Okay, the going concern concept is a fundamental principle of accounting. It's assumed that during the beyond the next fiscal period, a company will complete its current plans. Okay, use its asset and continue to meet its financial obligation. Okay. Next, a going concern is a business that is assumed will meet its financial obligation when they come due in financial in it function without the threats of liquidation for the foreseeable future. Also, for the foreseeable future, it's usually regarded as the least next 12 months of the specific counting period. Okay. For example, for the going concern, a state-owned company is in tough financial situation and is struggling to pay its debit. Okay, the government give the company a bailout and guarantees all payment its creditor. Okay, the state-owned company is a concern despite it's a poor financial position. Okay. I think that's all from me. Thank you, madam.